I'd like to move on to the Treasury market. Although the Fed has considerable power over short-term interest rates, bond investors, well, they're not convinced. The long bond has crashed from bubble-like levels here, and even the short-term Treasury, as of last week, is now finally showing signs of cracking here.
You look at the 10-year, we're at 3.9, and 3.9 is still very low, except when you consider it was 2% in December. So yields have almost doubled, 4%. I think that we could be on the 10-year. I think the 10-year can hit 5.5%, before this year is over. And that's a big move from 2 to 5.5%. A year later, they could be at 7 or 8% or more. And the conundrum for the Fed is, do they attempt to interfere with interest rate increases by buying up bonds in order to prevent the prices from dropping and the yields from rising? But if they do that, they have to print more money, create more inflation, and ultimately this makes interest rates go even higher. The government slows down the rate of increase in interest rates, but ultimately the actual peak of interest rates becomes even higher because of all the extra inflation the government creates to slow down the rise.
I'd like to underline and embolden that last point there. If the Fed and the Treasury do monetize the debt, as you outlined, I think that it will ultimately be inflationary. And of course, that would backfire, as you mentioned, because they're trying to hold these rates in a desperate attempt to keep rates lower.
Nobody wants to admit that rates have to go up, that rates are too low for a number of reasons. But that means all the phony asset prices that are only propped up as a result of low interest rates have to come down. See, high home prices are inconsistent with high interest rates. It's one or the other. Either we're going to have high home prices and low interest rates, or low home prices and high interest rates. And in a country that has no savings, right, it's got to be the latter. So we have to have low home prices. That's it. The minute we have low home prices, all the lenders are bankrupt. That's the truth that the government wants to prevent everybody from understanding.
I would like to hear your thoughts as how you see this working out with the yellow metal.
Well, gold's going to go up. I mean, either way, gold's going to go up. If the Fed takes the more inflationary route, if they try to postpone the pain of higher rates by creating even more inflation, and then, gold's path is even higher.
So you don't see then this as potentially a negative for commodities?
Commodities either go to the moon or they go to Pluto.
Speaking of going up, oil prices briefly surpassed $70 a barrel last week on the jobs report. What is it going to take to push crude back up to $147 per barrel?
Probably going to take a lot more money printing, which we're going to get, and a lot more dollar weakness. But I think we'll be there. I think that by the end of the year, we'll eclipse $100 a barrel again. And, where we go in 2010, we could easily take out 140 and go higher. But, the big difference between $100 a barrel in 2009 and $100 a barrel in 2007 when we first got there is back in 2007, people still had their jobs, people still had their home equity, and people still had a lot of money in their 401ks and their IRAs. Now, when you have gasoline prices up there, when people are unemployed and broke, it's going to be a lot more painful.
Well, as we wrap up here, the alchemist of finance, George Soros, I think said it best. Market bubbles don't grow out of thin air. They have an unshakable basis in reality. And if we use Soros' statement and the declining dollar as our guide, it seems to me the next big bubble could be in precious metals.
Ultimately, there may very well be a bubble in precious metals. I mean, we're nowhere near there yet, and there could easily be a bubble in mining companies and anything to do with precious metals. I think that bubble is years and years away from even forming. I mean, right now, I still think gold and gold stocks are undervalued. I don't even think they're expensive yet. So in order for there to be a bubble, they're going to have valuations that are completely inconsistent with the fundamentals. And I also think that when you have a bubble, it will be a situation where everybody is buying. I hear a lot of ads now, for gold companies and gold coin dealers, but I think I hear more ads for all these companies that are advertising these gold parties where they're recruiting people to buy gold from all their friends, to buy up, people are actually selling their jewelry for a fraction of its melt value in order to get cash. They have real money and they don't even know it. They're willing to trade it in for little pieces of paper. So by the time there is a real bubble, everybody's going to be wanting gold. No one's going to want to sell it. Everyone on your block, all of your neighbors will be buying gold. I mean, you won't even know a person who doesn't buy gold. Then maybe there'll be a bubble. We're closer to the bottom than the top.
Talking about buying gold, I mean, if you look at the long-term chart of the yellow metal, It's been winding up now for almost a year and a half. Looks like an explosive breakout could occur at almost any time in the next few months. Is that what you all are looking for at Euro Pacific?
Eventually, sure. I think once we take out 1,000, and really get above there, I think it'll be the equivalent of in 1982 when the Dow took out 1,000 after, over a decade of being turned back at that milestone. And, I think once we take out 1,000, it's going to move to 2,000 a lot quicker than it moved to 1,000, and then 3,000. Remember, on CNBC when they had the parties, every time the Dow went through another number, Dow 5,000, Dow 6,000, Dow 7,000. I think we're going to have something like that with gold as it eclipses one milestone after another.
And wouldn't you say then we might even reach parity with the Dow Jones Industrial?
Ultimately, at the bear market bottom for stocks, I expect the Dow and the gold to be roughly the same price.